You have $1 in your pocket. You want to turn it into 100. How would you do it? Would you study financial statements, wait for the perfect opportunity, and then hold your investment for decades? Or would you take bold risks, borrow money, and ride opportunities others are too afraid to touch? These two paths reflect the philosophies of two of the world's most famous financial minds, Warren Buffett and Robert Kiyosaki. Buffett, the Oracle of Omaha, is considered one of the greatest investors of all time. His wealth was built through discipline, patience, and an uncanny ability to find undervalued companies. Kiyosaki, on the other hand, became world-renowned through his best-selling book, Rich Dad, Poor Dad. He shook millions of people awake to the importance of financial education, assets, and alternative investments like gold and silver. But here's the twist: neither man is perfect. Buffett ignored precious metals for decades, only recently acknowledging their role in wealth preservation. Kiyosaki, while brilliant at spotting opportunities in gold and silver, has sometimes leaned into speculative assets and advice that contradicts his own principles. So which one is right? More importantly, which one is right for you? This video is not just about comparing two billionaires. It's about helping you understand your own personality, strengths, weaknesses, and goals, so you can discover the investment style that truly fits you. Stick with me until the end, because by then you'll have a clearer picture of whether you're more of a Buffett-style, disciplined value investor, a Kiyosaki-style, bold contrarian, or something uniquely your own. Warren Buffett's approach. Who is Warren Buffett? Born in Omaha, Nebraska in 1930, Warren Buffett showed an interest in money from an early age. As a young boy, he sold chewing gum, bottles of Coca-Cola, and delivered newspapers. By the time he was a teenager, he had already bought his first shares of stock. Fast forward decades later, Buffett became the CEO of Berkshire Hathaway, a holding company that now owns stakes in some of the world's biggest businesses, from Coca-Cola to Apple to American Express. At the heart of Buffett's philosophy is something called value investing. It's the idea that the stock market often misprices companies, sometimes dramatically. If you can recognize when a business is undervalued, you can buy it at a discount, hold it for the long term, and eventually reap huge rewards when the market catches up. Buffett often repeats his mentor Benjamin Graham's famous line, "Price is what you pay, value is what you get." He doesn't chase trendy stocks. He doesn't panic during market crashes. Instead, he looks for companies with three qualities: strong financial fundamentals, companies that consistently generate cash, competitive advantages, sometimes called economic moats, meaning they have something that protects them from competitors, competent management, leaders who act responsibly with shareholder money. One of Buffett's superpowers is his patience. He has said, "The stock market is a device for transferring money from the impatient to the patient." When others are panicking and selling, Buffett is calm. He buys quality businesses and holds them, not for months, not even for years, but sometimes for decades. That's why he often calls his favorite holding period forever. Strengths of Buffett's strategy: masterful knowledge of the stock market and general economics, incredible discipline and self-control, ability to see opportunities where others only see chaos, a proven track record. Buffett is one of the richest people in the world, and he did it mostly through stocks, not by inventing technology, not by luck, but by disciplined investing. Weaknesses of Buffett's strategy. Yes, even Buffett has weaknesses. For most of his career, he dismissed precious metals like gold and silver, He considered them unproductive assets since they don't generate income like a business does. But here's the catch. Gold and silver have historically preserved wealth during inflation, crises, and currency debasement. Many investors who held precious metals during turbulent times did very well, something Buffett long ignored. Only in recent years did Buffett's company quietly buy into a gold-related business, signaling a shift in his view. Fun fact about Buffett: despite being one of the richest men alive, Buffett still lives in the same Omaha house he bought in 1958. He eats McDonald's breakfasts, drinks Coca-Cola almost every day, and enjoys simple pleasures. His lifestyle is a living testament that wealth doesn't have to mean extravagance. Robert Kiyosaki's approach. Who is Robert Kiyosaki? Robert Kiyosaki was born in Hawaii in 1947. He served as a helicopter pilot in the Vietnam War before entering the business world. But it was his book, Rich Dad, Poor Dad, that changed everything, not just for him, but for millions of readers worldwide. The book tells the story of his two dads, his real father, a highly educated man who struggled financially, and his rich dad, a friend's father who understood money and investing. Through this contrast, Kiyosaki showed that financial education, not traditional schooling, is the key to wealth. Kiyosaki's core philosophy: unlike Buffett, who focuses on analyzing companies, Kiyosaki focuses on assets and cash flow. His central idea: the rich buy assets, while the poor and middle class accumulate liabilities. For him, assets are not just stocks. Assets can be rental properties, businesses, intellectual property, and most famously, precious metals like gold and silver. Strengths of Kiyosaki's strategy: he's a master communicator. Millions of people who never cared about money before became financially curious after reading his book. He emphasizes the importance of owning real, tangible assets. He identified the significance of the gold-to-silver ratio. Historically, when the ratio becomes too extreme, silver often rallies. Kiyosaki used this knowledge, at times even leveraging debt to buy silver, and he made enormous profits. He understands the power of good debt. Unlike most people who fear debt, Kiyosaki argues that when used wisely, for buying assets that produce income, debt can be a tool for wealth creation. Weaknesses of Kiyosaki's strategy: he can be overly speculative. At times, he has promoted cryptocurrencies and digital assets in a way that seems inconsistent with his physical asset principles. His advice sometimes feels sensational, leaning more toward motivational speaking than practical, step-by-step investing. Not all of his ventures have been successful. He has faced business failures and criticism over certain recommendations. Fun fact about Kiyosaki: before becoming famous as a financial educator, Kiyosaki actually launched a company selling nylon wallets with Velcro. The business was initially successful, but later collapsed, teaching him firsthand about the ups and downs of entrepreneurship. Buffett versus Kiyosaki, a comparison. So how do these two giants compare? Buffett is disciplined, analytical, and patient. He looks at numbers, company performance, and economic trends. His world is data-driven. Kiyosaki is bold, visionary, and contrarian. He looks at big-picture opportunities, alternative investments, and isn't afraid of leverage. His world is about seeing what others miss. One builds wealth slowly, methodically, like constructing a cathedral brick by brick. The other sometimes bets big, like a general leading troops into risky but potentially rewarding battles. But here's the surprising truth: neither is better. Both have strengths. Both have blind spots. The real question is not who's right. The real question is, which style fits you? Finding your own investment style. This is where you come in. You are not Warren Buffett. You are not Robert Kiyosaki. You are you. And to succeed as an investor, you need to know yourself better than you know the stock market or the price of silver. Step 1. Define your goals. Are you trying to build long-term wealth for retirement? Or do you want cash flow right now? Buffett's strategy is fantastic for long-term compounding. Kiyosaki's philosophy works well if you crave immediate income streams. Step 2. Know your skills. Can you read a financial statement? Can you analyze whether a company is undervalued? If not, maybe stock picking isn't your path. On the other hand, if you understand real estate or you can recognize trends in commodities, you might lean more toward Kiyosaki's style. Step 3. Understand your patience level. Buffett can wait 20 years for a company to pay off. Can you? If not, you may prefer investments with faster returns. But beware, faster returns often mean higher risks. Step 4. Educate yourself. Buffett reads for hours every day. Kiyosaki constantly challenges the conventional wisdom. Both prove one thing: without continuous learning, your money will outsmart you. Step 5. Choose mentors wisely. Not every guru is your guru. If someone's style doesn't resonate with your personality, don't blindly follow them. Pick mentors who align with your values, goals, and temperament. The biggest mistake to avoid. The worst thing you can do is copy someone else blindly. If you try to be Buffett without his patience, you'll panic and sell too early. If you try to be Kiyosaki without his boldness, you'll hesitate and miss opportunities. Your investment style should be as unique as your fingerprint. Conclusion: Warren Buffett and Robert Kiyosaki may walk different paths, but both share one truth. Wealth is not built by chance. It's built by choice, by discipline, and by education. So, which path will you take? The careful, patient road of Buffett? The bold, contrarian road of Kiyosaki? Or will you forge your own? If this helped you see things differently, drop a comment and we'll answer your questions. Subscribe for more honest finance content, and remember, smart money doesn't sit. It moves.